The euro has dropped to near parity with the US dollar, and that is a 20-year low for the European currency. So, what's going on? Well, let's take a look at this 1 year chart of the euro to US dollar, and you can see there has been a downward trend for the past year. However, in February, when Russia launched its invasion of Ukraine, you can see that that downward trend really accelerated significantly, getting us to near parity today. And a lot of this weakness that we're seeing in the euro has to do with the energy crisis that is currently going on in Europe. Yesterday, Russia shut down the Nord Stream 1 pipeline. That is a major pipeline supplying natural gas to Germany and the rest of Western Europe. And this is supposed to be for routine maintenance that'll last about 10 days. So by July 22nd, this pipeline should be back up and running. Although there is a lot of fear in Germany and throughout the rest of Europe that this pipeline might not be reopening anytime soon. We already know that prior to this shutdown for maintenance, Russia had slashed the flow of gas by about 60% through the Nord Stream 1 pipeline, and there's already very tight supplies of natural gas in Germany and the rest of Europe. And there's a major risk of recession as energy prices are spiking up throughout Europe. Last week, we got this warning from the head of the German Federation of Trade Unions that a number of industries could risk collapse on spiking energy prices. This is Yasmin Fahimi, the head of the German Federation of Trade Unions, warning that industries such as aluminum, glass, and the chemical industry could take a big hit if gas prices continue to spike. And certainly if that Nord Stream 1 pipeline doesn't reopen, there's going to be a lot of pain. Now, this is the 3-month chart for Dutch spot natural gas, and you can see that since June there's been a very significant upward movement. Back in June, the price of natural gas was about 84 euros, now 172, so more than a 100% increase over the past month in the price of European natural gas. And this could lead to major pain. German chemical manufacturer BASF, they recently warned that they might have to shutter some factories. German society as a whole, they're already taking a number of steps to try to conserve energy. They're reducing the brightness of their streetlights. They're shutting down certain public buildings like swimming pools that require a lot of energy to heat. They are reducing the temperature in homes and apartments, the minimum temperatures that landlords are allowed to keep those properties at. So they're doing a lot to try to slash their consumption, but I suspect it won't be enough. The supply is just going to continue to get tighter and tighter, especially, like I said, if the Nord Stream 1 pipeline doesn't reopen. Now, it may not, because the European Union, they're working on their 7th round of sanctions against Russia. So, if Russia wants to do them a favor back in their economy, they might just stop sending gas to Europe. And Europe is highly dependent on Russian natural gas. Russia may have to sacrifice some revenues from the sale of gas to the European Union, but for one thing, they've likely got ready buyers for their gas in other markets like India and China. They're working on a pipeline that can divert European gas over to China, and that's not open yet. But, as far as the long-term plan, I think we know where that gas is ultimately going to end up getting shipped in the future. And also, while Russia may have to bear some revenue loss, I think that the negative effects of a cut of Russian gas to Europe are going to be disproportionately felt by European economies. And all of that has to do with the weakness in the euro that we are seeing at the moment. And that is largely what is causing this decline in the European currency as the European Union heads into what is looking like maybe a very significant recession as the price of energy is spiking there. But it's not just the euro that is experiencing weakness. The US dollar may be moving up relative to other fiat currencies, but relative to real stuff, it is continuing to lose ground. The inflation numbers for June are going to be coming out tomorrow, and it is expected that we will see an 8.8% CPI. So that is even higher than the numbers for May. The inflation numbers continue to tick up. Even the White House is warning that the numbers will be highly elevated. So, when the White House says inflation is going to be high, get prepared, because it's probably going to be a very big number. And we know also that the CPI largely understates the effects of inflation. And so, 8.8% CPI means maybe 16, 17% real inflation here in the US. It's not just a phenomenon relegated to Europe. It's just that, when you're measuring these fiat currencies against one another, some may be sicker or more doomed than others, but ultimately, there's never been a fiat currency that has survived the test of time. If you can name one, please let me know in the comments down below if I'm mistaken about that. But ultimately, all of these fiat currencies end up going to zero, and if they manage to stick around, it's in some extremely devalued form. There have been a lot of fiat currencies over the years, and the vast majority of them have been relegated to the trash heap of history. Now, one thing I do think investors should be focusing more on is real money, gold and silver, and that's something that's taking a big hit today. If we go back over here to the Yahoo Finance page, you can see that gold and silver both in the red. They've recovered a little bit from their lows of the day. Earlier, silver was under 19 bucks. Crude oil taking a big hit today too, and that is likely on fears of a recession because this recession that's likely going to hit very soon in Europe and be exacerbated as they head into the winter months and there's even higher demands for energy. It's not going to be relegated to Europe. It is going to affect the US as well. Later this month, we're going to get the Q2 GDP numbers, and I think that will reveal that we have been in a recession. And it looks like investors think that that is going to put a cap on the price of oil, at least from the market action today. Although I do think investors are likely getting that wrong. Even if recession does reduce consumption of oil globally, the supply issues are going to continue to get worse. There's unrest around the world in a lot of places. Libya is having significant unrest. Ecuador, they're experiencing unrest, and that is slashing the oil production in those countries. And so there's other factors weighing on the supply. But the real big problem is going to be this EU oil embargo on Russia. At the end of the year, they're going to stop insuring Russian oil shipments to the rest of the world. And so, and that is the ships, carrying them. They're going to stop insuring those. And it looks like this oil cap plan that the G7 had put together now is being shelved, at least for the time being. And so at the end of this year, the supply problem is going to get a lot worse. And regardless of how bad the recession is in the US and Europe, and I think it's going to be bad, the price of oil I expect to be going much higher. And that is just going to contribute to the pain that those Western economies are going to feel. And so, that's something that investors should keep in mind, that right now, even though gold and silver are in the red, it's really just a huge opportunity to get into hard assets, to get out of these falling fiat currencies, because even if the euro is cheaper relative to the dollar, the dollar is also declining in value. That is why we are seeing inflation continue to spike up out of control. And, that's why you want to be out of fiat currencies and into hard assets like gold and silver. At least that's how I see it. Let me know what you think in the comments down below. Thank you all very much for watching. Don't forget to like, comment, subscribe, and I will catch you next time. Smart Silver Stacker, out.